In this video, we are going to do an introduction of the arbitrage pricing theory. So, arbitrage arises if an investor can construct a zero investment portfolio with a sure profit. This is a way to say that you can take advantage of an opportunity in the market without having to put your own money in. Since no investment is required, an investor can create large positions to secure large levels of profit. In efficient markets, profitable arbitrage opportunities will quickly disappear, meaning that as soon as there's an opportunity present, something is just off place. That's what happens. Something is off the line, off balance. And when that opportunity is identified, you can take advantage of it and start profiting from it. But whether it's just you doing it or a group of people identifying the same opportunity and profiting it, as soon as you start that process, then it starts adjusting, and then it goes back to efficiency, and then it disappears. And in this day and age with technology and speed, it's really fast. Let's review some vocabulary terms that you should have seen, hopefully, in a previous finance class. We have total risk. That is the combination or the addition of systematic risk and unsystematic risk. We will define those two in a minute. We have the standard deviation of returns. That is a measure of total risk. For well-diversified portfolios, unsystematic risk is very small and almost non-existent. There's always just this very small amount in it, but it's so small. If you do it right, that is almost like if it wasn't there. Consequently, the total risk for a diversified portfolio is essentially equivalent to the systematic risk. We'll talk more about this in a moment, but just understand that when you diversify, you're eliminating that one. So let's talk about that graph for a moment, because that's really where we can start defining. So notice, we'll have variance here, but if you take the square root as a standard deviation, so that is the total risk, right? This N here talks about, it's like a count of how many stocks in a portfolio. We'll talk about that in a moment. The idea is that if you only have one stock, if your portfolio is only one asset, then you're not diversified and you're taking the total risk. So you're going to be somewhere up here, N being 1, so close to 0, but you have the entire risk, the entire total risk, systematic and non-systematic, unsystematic also known as. The idea is that as you add more stocks to a portfolio, it starts to become diversified. As you do that, that standard deviation is going to start coming down because it's eliminating that unsystematic risk, also known as non-systematic risk, also known as diversifiable risk. So this portion above this dashed line can be called unsystematic risk, non-systematic risk, and diversifiable risk, because you can diversify it away by adding more and more stocks in a portfolio. There's a lot more detail and nuance to it, but that's the general idea. The more different assets you have starts dropping this. They become more efficient. However, do understand that systematic risk, we currently don't have a way to get rid of that. That is the risk in the system, the economy as a whole. There's always some inherent risk that applies to everybody. It may apply to everybody different degrees and different levels, but it does apply to everybody. So that part, we can't do anything about it. It's just part of the nature of the beast. This is the part we're talking about. So above the dashed line, non-systematic risk, unsystematic risk, diversifiable risk. Those are common names you will find there. Standalone risks is also called. But down here, systematic risk, non-diversifiable risk, maybe called also market risk, because it's the entire market that belongs there. As we explained, that the entire economy is subject to that part of the system. Let's cover a little more vocabulary. Beta, you hear it all the time. The beta coefficient tells us the response of the stock's return to a systematic risk. Okay, so remember we said that everybody is subject to systematic risk, but at different degrees. It's impacted by systematic risk in different ways, some more, some less. So beta, that's what it's doing, is measuring that risk of that asset in relation to the systematic risk and how it's being impacted by it. So to go over a few things that you should have seen before in a previous finance class, the market risk, systematic risk, we always going to call that 1. Beta is going to equal 1. So we use that as the benchmark measurement. So regardless of what kind of risk or volatility or high lows the market has, we fix it at 1, and then we compare everything around that 1. And that is the response of the stock's return to a systematic risk, that relationship. So if a stock or an asset or a portfolio has a beta higher than 1, then they have higher risk than the average stock, than the market. And the opposite is true if it's below 1. If it's equal to 1, they're about the same. In CAPM, Capital Asset Pricing Model, beta measures the responsiveness of a security's return to a specific risk factor, the return on the market portfolio. So then if we have beta to have it as a comparison to the market, then you can use CAPM to then calculate a required return based on the beta. And this goes back to the fundamental concept of risk versus return. The higher risk you take, the more return you should receive. So if a stock has a beta higher than 1, then or an asset or portfolio has a beta higher than 1, then they are riskier than the market. So it should be returning a percentage higher than the market. And we'll talk about that calculation in a moment. And the opposite is true. Lower than beta 1, you would expect a lower return, or you would require lower return in comparison to the market. This formula here is just showing you how it takes that responsiveness relationship. So the RM will be the market, return on the market. The RI will be the return on the portfolio, the asset, whatever it is that you're measuring. And what we do is you take the covariance of those two, and then you divide it by the variance of the market. So you take the covariance of the market and the asset divided by the variance of the asset, and it gives you beta. And that's how you capture that relationship an asset would have with the market, that volatility, that responsiveness they talk about. So the market changes, it will change accordingly. So let's talk about some other details out there. A few more details if you haven't seen it before. And we're going to talk about a diversified portfolio. And it's because for this arbitrage pricing theory, it's important to understand that we have to be working with diversified portfolios. Arbitrage can be applied in other type of assets, but the approach is different. Calculations are different. Here, we're going to be discussing diversified portfolios because it's a good starting point. Things to remember in any portfolio, whether it's diversified or not, the expected return of the portfolio, it's the weighted average of the assets in there. So if you have 10 different stocks, each stock is going to have a different expected return. And you may have different amount of money on each stock within the portfolio. So that's going to create the different weights. So if you go ahead and multiply the expected return of each of the assets in the portfolio times their weight in the portfolio, the amount they represent of the portfolio, and then you add them together, you're getting a weighted average. And that's how you will calculate the expected returns of a portfolio. For the beta, you do the same thing. Each asset in there is going to have its own beta. You multiply the beta times the weight, add them together. The weighted average of the betas will become the beta of the portfolio. Now, here in this note to the bottom, in a large portfolio, the only source of uncertainty is the portfolio sensitivity to the factor. Now we're talking about betas here. So we go back here, remember large portfolio, this will go away. So we're just talking about systematic risk. So we're talking about beta 1. So, and that's what they're trying to say, that if you have a large portfolio, then it's well diversified and you're not going to have this problem up here. You're only dealing with this piece. So you're only going to be the only part of uncertainty in the sense of risk will be the portfolio sensitivity to the factor, the beta that we're using now. Now, I want to make clear what they mean by a large portfolio. A large portfolio does not mean, in this scenario, in what they're trying to explain here, it does not mean a lot of money in the portfolio. It means a lot of different stocks or different assets in the portfolio. So if you have a portfolio with $10 million in it, but it only has 2 stocks, and you put it next to, you compare it to a portfolio with $10,000, but it has 100 different stocks in it, the large portfolio is the one with 100 stocks in what they're discussing here, not the one with $10 million. So when they say large, they mean large in the sense of a variety of stocks, not large in amount of money, because they're talking about diversification. Okay. Let's talk about the relationship between beta and expected return. That's what we mentioned earlier. If you know the return of the market and you know the beta of the market and you know the beta of the asset you're trying to measure, we throw in the risk-free rate. We'll talk about it in a moment. And you can calculate what kind of return that asset should be receiving. And this right here, you may have seen it just like this, or you might have seen it looking a little different, but this is the capital asset pricing formula. The expected return, you may have also heard required return of an asset. You take the risk-free rate plus the beta multiplied by what's inside the bracket. This piece inside the bracket is known as market premium or market risk premium. And what it means is that the risk-free rate, it's exactly what it sounds like. It's an asset with no risk. Typically, we use the federal bonds for that risk-free rate. So what we're looking for inside that bracket is how much is the market, the part with a systematic risk, is returning above the risk-free rate. And that's what's called, that's the premium part. There's market risk and market return. Now, the return, the risk premium, how much is returning above the risk-free rate, that's what you're getting there. And that's the piece you want to multiply beta. The reason I made an emphasis on this market risk premium is because if you see an exercise that you need to calculate this formula, and they tell you the information they give you is the market rate and also the risk-free rate, then you'll follow this formula just as it is. However, if the piece of information they give you is the market premium or market risk premium, what they're telling you is that this piece in here is already done. You don't have to take the step. So be careful with that. It's a common pitfall or mistake made. Market return and market risk premium, both are represented as a percentage, but they do not mean the same. Market return, you do this piece in here. Market risk premium, if you have it, you do not do this piece in here. You just take the number and multiply by the beta. And then you add back in the risk-free rate. And they'll give you a percentage, and that'll be the expected return of the asset, the portfolio, the stock. Now, when you use that formula, look, we repeated it here down here. If you were to graph it at different betas, this is what you should get, the security market line. So we have here, the bottom is beta from 0 all the way to whatever beta you have in your asset. In theory, it's an infinite. Betas can go as high like that, but obviously, the reality is there's some limitation where you're not going to see a number higher in a certain amount. However, no, betas can go infinite. So you can see a high beta is just a high risk asset. And here on in this axis, you have the expected return. So if you're given any beta, you use this formula and you'll get the return and you can plot it. If the market is operating efficiently at the moment and things are in equilibrium, everything's balanced out, there's nothing off place, then the dots will fall on the line as you calculate. So let's talk about portfolio B and portfolio D. Let's assume that these are two diversified portfolios with any given beta. Obviously, well, B, what they're telling you is when you do the formula, B will have whatever beta falls here. You do the formula, and it means that the expected return is in this range. Now, this makes sense. That has to be above the risk-free rate, because if the risk-free rate, treasury bonds, federal bonds, etc., it's 0 beta, that's what risk-free means, and it starts here, then anything with a beta above 0 should give you more returns because you should be compensated for the additional risk. So B, portfolio B, has some kind of beta, and that's where it belongs. It's on the line, so things are efficient with there. Portfolio D has a higher beta. You put it in the formula, and it should give you an expected return there, and is on the line. So B and D are in equilibrium. They are returning what's required or expected according to their beta, according to their risk. Now let's talk about portfolio alpha here, portfolio A. What we see here is that portfolio A has a beta down here. So with that beta, it should have a return somewhere on the line here. Makes sense? A beta lower than portfolio B. It should have a return lower. However, it's above the line. And furthermore, it's above portfolio B. But what's important is that above the line, regardless if it's above portfolio B or not. This means that this asset, this portfolio, is returning a higher rate or has a higher rate of return than what would be expected considering the lower beta. So it's outperforming, it's doing better than expected. When that happens, you may have this opportunity to apply a little bit of arbitrage. And the point is that you can start investing in this stock, start buying it, because when it's returning more than we're supposed to, the price of the stock should be going up. Now, as people jump in and take advantage of that mispricing, that's how we call it. Mispricing is not a bad thing. It just means it's off where it should be. So as people jump in and start buying it, that's going to start bringing the price up. And as the price goes up, the return starts shrinking. So that dot is going to start moving down until it gets back online where it's supposed to be. Now, there could be an overreaction. So it may go ahead. Typically, that's what happens. It starts dropping and it goes below the line. The people are like, oh, wait, we did too much, and they start getting out of the stock, and then eventually sits there. That's what we call overreactions and underreactions. Now, same thing here with C, but it's the opposite. C is not returning what it's supposed to for the higher beta. It's way down there. That means it's overpriced. The price is too high. So people are going to start selling it because they're not getting the money they're supposed to for that level of risk. So what you can do, you can short sell this asset. And as prices dropping down because the current owner starts selling their asset on this because it's no good, as they start selling that and the price is going down, that dot will start moving up. But because you're short selling it, you're going to make money as the price goes down, at least until it hits the line here. Now, for the arbitrage detail mentioned earlier about doing a zero investment profit strategy, a zero investment strategy that leads to profits, in this example, what you would do is you short sell one of these. And for that matter, you can short sell B or D, but in this example, you're better off short selling C. I'll explain the B and D in a second. Let's explain C. So what happens is you short sell this one. So you're going to get some cash up front, because when you short sell, you have a cash inflow. You take that cash inflow and you go long on this one. So you never used your money. You did a short sell, money came in. You took that money, you put it over here. So as the market did what it's supposed to do to get back online, you're going to be making money here and making money here. Then you sell. When you're ready, you exit, and you made money on both without putting any money in. So that's a zero investment strategy. Now, for that matter, you could do it with one of these two as well, because what's important is that one is off the line. In this case, both were off the line, so it's very profitable, but all you need is one off the line. And the reason is you short sell one of these two. Now, you are going to have a loss because these are not going to profit from the short sell. But because you short sell them and they're there, your loss is going to be not too bad because they're not moving really. You take that money, you invest it in A until A comes back in equilibrium, and then you exit. And then with the profits from what you made here, you pay the losses you had here, and you had a zero investment, and you still kept some money after. So it's a zero investment situation. You did have in the first example, you made money on both, you're good. Second example, you took a loss, but you made more money here because the loss here would have been less. And there's a mathematical way to decide on that. But the point is, it can be done when one of them is off. Now, choosing which one to short and long, that's, like I said, is a different concept. But the point is, you short one, you take a long position, you take the money from the short, you take a long position, the other one. And on average, one will have losses, but it'll be much less than the one that you had gains with. And you pay the loss with the gains, you kept money. But what's important is you never put any of your money in. So the capital asset pricing model and the arbitrage pricing theory are closely connected. APT applies to well-diversified portfolios and not necessarily to individual stocks. Like I said, here we're talking about the diversified portfolio. And the reason they make that point is because you're taking away the unsystematic risk, then it improves the situation and the scenario in order to take advantage of this. There are strategies to do it with individual stocks. We're not going to touch on that here, but then that becomes a more complex calculation and with different levels of risk because of the unsystematic risk involved. With the APT, it is possible for some individual stocks to be mispriced. And that's what we're talking about here. That's what we just spoke about here, not falling on the line. That's mispriced. APT is more general in that it gets to an expected return and beta relationship without the assumption of the market portfolio. Since we already, since we're dealing with a diversified portfolio, we are taking out the unsystematic piece so we can do these calculations and strategies without necessarily having a market portfolio in place, because it's about being on the line or not. It's about being where you're supposed to be or not. It has less to do with the relationship with the market. We use the beta once calculated, so we compare those figures and use it to our advantage, but you don't need that assumption of the market portfolio. APT can be extended to multi-factor models. This is very true. And generally speaking, just about anything in finance, you can start with some simple models and you can continue adding variables all you want to get a more predictive model. But the trade-off is then you need more data, more time, more work, and the improvement you may get by adding multi-factors may not be that great. In some scenarios, yes, some scenarios, no. Those are still being part of the research debate out there of what are the actual variables you should be adding or not. Okay, that's it for this video. See you on the next one.